Guys, I think I just found a solid piece of data that could explain why crypto prices and stocks have rallied in the past 2 weeks. Our hypothesis so far has been that it's due to institutional and Wall Street hedge fund speculation that the worst of the recession is over and the economy won't get much worse. They bought in at lower prices, speculating that prices had hit bottom. However, this was just a guess based on our feeling without actual data. Well, this time I found actual data that supports our hypothesis. And in this video, we'll discuss that data and what it means for crypto and stock prices in the future. Well, spoiler, the data I'm referring to is the Fed Funds Futures. So, hi, I'm Sylvester and this is Crypto Ice Cream. Well, let's go. So, what are Funds Futures? They are derivative products, meaning the underlying assets don't exist. Well, derivatives are usually created for specific purposes. In theory, the main purpose is to hedge investor risk. But in reality, the largest use of derivatives is for speculation. An example of a common derivative is the S&P 500, an index of 500 companies listed on the American Stock Exchange. So if I believe the economy will be good and in the future, and I want to invest in stocks, but I'm too lazy to research each stock individually, I can buy the S&P 500 products. If my guess is right about the good economy, then the performance of the S&P 500 companies should be also good. Their stock prices should go up and so will the index price, and I will profit. So let's take a look at the Fed's funds rate chart. So on the x-axis, it shows the information about the amount of federal funds rate in basis points. So the farthest right is 525 to 550 BPS, which is 5.25% to 5.5% in percentage. On the y-axis is the information about how many of the market choose a certain federal funds rate. For example, according to the official information from the Fed, the federal funds rate should be around 4.75 to 5% by the end of this year. But the market doesn't believe this official information. And how can I tell? Because only 19% of the market speculated that the federal funds rate would be at this rate. Instead, more of the market bought federal funds futures below the official Fed's info. 34% bought at 450 to 475 BPS and 28% at 425 to 450 BPS. And this means that there are several possibilities. First, it shows that the market has a low confidence in the Fed's words, meaning that the Fed may have difficulties implementing its strategy if its words are not believed by the market. If the market believes that the federal funds rate will be lower by the end of this year, well, it means that the market considers that the economic condition will continue to improve in the next few months. Well, that means the trend of declining inflation will continue, the strong job trend will persist, and also the federal funds rate will be set at the informed rate, if not lowered. And thus, the market believes this improvement in the economy will make the Fed change its course and start lowering the Fed funds rate this year. And I believe we are seeing this trend as we speak, as money parked in dollars is flowing into riskier assets such as stocks and crypto. The value of the dollar is down, the stocks are up, and crypto is soaring. And if the market believed what the Fed said, then more money would be parked in bonds or low-risk assets instead of high-risk assets like stock. And if we look at the price of bonds and interest rates in America, they're not moving much. And so I believe these two data act as a confluence, supporting each other and confirming my previous guess about why stocks and crypto are green. From a technical analysis point of view, the Dow Jones, S&P 500, and Nasdaq have all broken their bearish patterns. On the other hand, this phenomenon on the market is not of the market not believing the Fed could force the Fed to raise the federal funds rate even higher above their target this year. And why is that? Because the main reason for raising the federal funds rate is to reduce the amount of money in the market. If the market ignores them, well, it means that there will still be lots of money circulating in the market. And in the end, inflation will rise again. The danger bell will ring again, and the Fed will be forced to raise an interest rate higher than their target. So the conclusion of this video is that there seems to be a battle between the market and the Fed right now. And this will make events such as the FOMC, the inflation data, and unemployment more crucial. Why? Because the current stock market and crypto prices reflect the scenario that the economy will improve in the upcoming month with declining inflation, increasing employment, and a minimum Fed funds rate equal to or even lower than the target. If the unemployment or inflation data released are worse than market speculation, the market may change its mind about the economic condition from optimistic to negative. The outcome of this battle depends on the data to be released. This might be what BlackRock means in their 2023 outlook, where they mention an investment strategy which is constantly vigilant and adapting to market changes. So no longer using the strategy of buying the dip and sitting calmly waiting for a price increase. And what do you think? Well, see you on our next Crypto Ice Cream.